The problem with most financial shows when it comes to calling the market is that it's one guy's opinion over and over again.
Sell, sell, sell.
But any veteran investor knows that there are two sides to every trade, a buyer for every seller and vice versa.
Buy, buy, buy!
That's why MoneyLife brings you a wide range of experts.
I need people who, can work well under pressure.
Each day you get the benefit of a new set of eyes on the market with different methods and decision-making tools. Every day you'll hear a different expert giving their take on the market, on what looks good, what looks bad, and how they feel about some of your stock selections.
This stock is blowing up right now.
You never know who might show up to talk stocks. It may be a famous money manager or someone you've never heard of before.
Go!
But you'll always get their straight talk.
Must you always be so blasted honest?
Their straight talk, that is, about what they see happening on the market and where to think about putting your money on the daily MoneyLife market call.
That's right. It's MoneyLife market call time, and I could not be happier than to be welcoming Brent Wilsey back to the show. Brent is president of Wilsey Asset Management, and he's one of my favorite advisors when it comes to stock picks. When I used to do Stupid Investment of the Week, I would check in with Brent as often as just about anybody out there, in large measure because he takes a very practical approach to how he looks at stocks, and it was a good check and balance for me as much as anything. I would occasionally find myself saying, I'm looking at this way, and then Brent would be telling me, maybe you shouldn't be looking that way. So it's always interesting to chat with him. He hasn't been on the show for a while. If you want more information, if you want to find out what he's doing, because he's pretty active in the media, WilseyAssetManagement.com. He's on Twitter at Brent Wilsey. But right now he's here, and I'm very pleased to say, Brent, welcome back to Money Life.
Great to be back, Chuck.
I talked about your methodology, and yours is similar to a lot, but you tend to focus on a couple of things that not everybody does. So explain what you do. What is it that you look for that makes you say, here's my buys and here's my sells?
Well, Chuck, it's actually pretty easy because what we're looking at doing is we're looking at buying small pieces of large companies. And we'll look at what we're paying for the earnings, for the book value, the sales of the company. We want to make sure that they can weather the storm, so we make sure they don't have a lot of debt, that they have a good current ratio so they can pay off their current bills. I want to see, are their sales growing? Are their earnings growing? We'll look at other things like the receivable turnover and the inventory turnover to make sure they're not going to have problems, writing down inventory or not collecting out the sales they made and so forth. So we look at this as if we could buy the whole company, would we buy it? If not, we're not going to buy that stock or a small piece of that business.
But where a lot of people say I'm buying companies, they're looking largely at valuations and the quality of the business. You are using the PEG ratio more than you use some of the other metrics. Why is the PEG particularly important to you? And given today's market where we've got a lot of people talking about valuations on this show and most of them sort of unhappy with valuations, are you seeing the same thing when the PEG is so important to your decision?
Yeah, and Chuck, there's many different things we look at. It'd probably take me a good half hour to explain everything we do. We actually do workshops that we spend about an hour and a half showing what we do. But the PEG ratio is one part we look at because the PEG ratio stands for price earnings divided by growth. So it tells you how much you're paying for the future growth of a company. And everyone might say, it's great, they got all these people coming and so forth. But you find out that's already built into the stock. So look at the PEG ratio to make sure you're not overpaying for the future growth of that company.
Okay. And when you look at the broader market right now, what do you see in terms of valuation? Since you're looking at buying the business, but buying it at the right price, are you finding that, hey, with the run-up that values had this year, everything's a little pricey right now, so it's hard to find buys?
Well, it is hard to find buys, and that's when I kind of know that, okay, things are getting kind of pricey here. And when we look at the index, the S&P 500, one thing we've done, we said, wait a minute here. The index is a market cap weighted index. So these companies like Facebook and LinkedIn and Amazon, these companies that their stocks have just gone up, to unreasonable valuations because of the big market cap now, they take account for a lot of that S&P 500. So we've actually hedged our portfolio on the S&P 500 to maybe about 10% of the portfolio because I think we could have maybe around a 10% correction or so just because of the market cap weight of these companies that are way overpriced. When I look at companies right now, I'd say about 1 out of 10 have good valuations. The other 9, pretty pricey.
So what does that mean you're doing? Does that mean you hold what you've got because you had good values when you bought it and you're letting it ride out? Or does that mean you take your profits and you go to cash?
No, I never go to cash because, again, we are long-term investors. We are looking for good companies at good prices, and you can still find them. I found one today that we'll probably talk a little bit about. But when I look at the overall market, yes, it is expensive, but you've got to find those good companies. And, again, if you paid $10 a share for a company and our target sell price is $15, I'm not going to sell that company because I think the index could go down. There's actually, companies that will still go up even when the index goes down. So look at the businesses, but understand that, yes, I think the S&P 500 right now is on the pricey side.
What is the sell discipline? If we know what the buy discipline is, what is the sell discipline? Because, as you point out, you're a long-term investor and you're not going to cash. What is it that's going to make you sell?
That's a great question. What we look at is that the 40-year average of the forward PE of what you're paying for the earnings down the road about 2 years is around 16.5 times forward earnings. So we'll look at the forward earnings based on the average of all the analysts and say, okay, that comes out to be $50 a share. If the stock is 45, we'll hold that company because based on the average over 40 years, it's not too pricey yet. But if it hits that, forward PE of 16.5, we will sell and get out. And again, that's not the average. That is the average. It's not the peak, but I'm very conservative, so I'd rather sell out early than stay at the party too long.
So let's talk about a name or two that makes it through the process and that looks good to you right now.
Well, right now there's a lot of talk, and probably everybody talks about it, is Apple Computer, which Apple Computer, it's been beaten up, and the watches aren't going to do good, it's not going to do good. It is probably one of the cheapest companies on the market right now because it is, doing all the right things. They make a lot of money, and you're only paying around 10, 11 times earnings for that company. It's a great deal, and we find a lot of good things in retail as well. Retail right now, there's some good companies that we've looked at, like Kohl's. Kohl's is doing a great job. You're not paying much for the stock of that company at all. They've pulled back down. That's when you're going to buy them, and I can't tell you when it's going to turn around. But, gosh, Kohl's has a 52-week high of $65 a share. Right now you can buy it for around $35 and pay around 10, 11 times earnings. And in the meantime, you collect a 5.6% dividend. So look at buying this small piece of this company and be patient. I think you'll do pretty well by buying a retailer like Kohl's. Okay,
I got to step in for a second because you mentioned Apple first. And Apple has been talked about on this show a bunch this week. We've had folks who've had it as a sell. In the last 2 weeks, I think we've had it both as a buy and a sell. But we had a discussion earlier today on the show with Doug Ramsey, the chief investment officer at the Luthold Group, who had made a point that I haven't heard on Apple stock before. So I'm curious what you would do. He wasn't really talking about the stock as a buy or a sell, but he was talking about how the stock has now gotten to where it's more than 4% of the S&P 500 index. And that while it's not the first stock to achieve that, every other stock that has ever achieved that status has been unable to hold it and has wound up being beaten back until its market capitalization was smaller. It was a different sort of company, and then what have you. So when you hear that, is that something that you would look at that would give you pause, or do you hear that and go, hey, that's somebody looking to make a case against Apple, and sure, that's one more case, but you would ignore it?
I would ignore it because when you compare it to the other companies that happened to, I would bet you that their valuation ratios on their earnings was very high. Apple, you're paying, again, I believe around 10, 11 times earnings for that company. Very good valuation ratios, and they've got a lot of good things going on. People talk about their operating systems. Apple, you've got now the Apple Pay. You've got the App Store. They have a lot of reoccurring revenue that they're building over the time frame. And the iPhone 7, it's not going to be like a major turnaround thing, but it's a new thing. It's like, people don't, hold on their cars for, 3-4 years. I want a new car. Same thing here. You got maybe an iPhone 4. The 7 comes out like, you know what, I think it's time to get an iPhone 7. So they do very well. Also, too, India is starting to pick up a lot of iPhones now in addition to China. So it's just a well-run company. I don't worry that they're 4% of the S&P 500 because, again, it's a good company. It could go to 5% of the S&P 500. But here's a business that's doing very well, and while you're waiting, you get a 2.3% dividend. I know yesterday, I think it was J.P. Morgan Chase came out, and I think this is so funny when analysts do that. They said, we're lowering our target price down from 125 down to 105. But then they also say that they reiterate to overweight the stock in your portfolio. So I'm thinking, isn't it a mixed message? You're saying to overweight it, but yet you reduce your target price. You got to look at the business. Forget about these short-term moves of the stock. Forget about, it's this and that and so forth, because all scenarios are different. You've got a great business getting revenue from many different sources, and their balance sheet is strong. They've got, $200+ billion in cash. Great company. Just look at the company and think, where will this company be 2, 3, 4, 5 years from now?
Well, I think in the middle of that answer, you described me. I'm the guy with the iPhone 4 who knows I'm going to get the next one at some point. And, by the way, I'm waiting for the 7 at this point, so might as well.
There you go.
Well, now we're going to find out how you feel about some stocks that my audience is particularly interested in.
Play, hold it,
You got to know when to hold up.
or fold it.
Know when to fold up.
It's Hold It or Fold It time with Brent Wilsey, the president of Wilsey Asset Management out in the San Diego, California area. If you want more information, just like it sounds, it's wilseyassetmanagement.com. Brent is on Twitter. He is at Brent Wilsey. Hold it or fold it? Well, that's easy enough, too. If you are interested in participating, send your name, your hometown, and the ticker symbols you're interested in to Chuck at MoneyLifeShow.com. We'll add it to our list. Hopefully you'll make it into an interview soon. And the most recent addition to the list was Mark in New York City, who, along with Kirk in Huntsville, Alabama, wanted to know about ALK, Alaska Air Group.
Alaska Air Group. Now, this is something that is kind of interesting right now because Alaska, we see that the current price is around $60, $61 a share. We looked at their earnings going out to December 2017. They're $7.40. That gives me a target sell price of $122. Right now, you're only paying 8 times earnings for this company. They've grown their earnings by 41% year over year. They've got a good balance sheet. They got about 26% debt to equity. And when I look at their profit margin, they've got a 15.6% profit margin. I mean, they're doing very well. The thing concerns me, if you think oil is going to go way up in price, could hurt them. They do hedge their oil, but I still like this company. But be careful because oil movements up or down can move the stock up or down as well. But again, what a great business.
Yeah, that's a call for a soft landing on Alaska Air Group, ALK. That was a buy.
Either gets on board or he gets left behind.
Yeah, get it. Get on board. Right. Jeff in Durham, North Carolina wants to know about Merck and Company, MRK.
Merck is a drug company. I think the whole drug industry has come up a little bit too much. Merck trades around, $55, $56 a share. I went out to December 2017 to look at their GAAP earnings, and GAAP are generally accepted accounting principal earnings, of the strong earnings, not the hoax of, take out this, take out that. It's the true earnings of a company. They're only $3.76. Gives me a target sell price of $45.87. Right now, you're paying about 20 times forward earnings for this company, a little bit pricey. And when I look at their earnings, they're down 57% year over year. They had some write-offs. Sales are down 5% year over year. People may be enticed by that 3.3% dividend. Also, yesterday, they won some lawsuit that's going to help them out a little bit there. But I just think it's too expensive. And Merck's a well-known company, big company, but it's like the whole index. It's just too pricey at this point in time. I'd have to sell it if I held this company.
And now for the profit taking.
That's a sell on Merck and Company, MRK. Josh in Petaluma, California wants to know about American Homes for Rent. That's AMH.
You know, I was very disappointed when I saw this because I like the concept of renting homes. I think the real estate market going forward is going to do well. We actually own a builder in our portfolio. This company actually rents out homes. That's the type of REIT they are, renting out single-family homes. When I kind of looked at their numbers, I saw they have a debt to equity that's 92, which is not too bad. The sales are up 53%, but earnings only climbed by 3%. But then when I looked at the going for the earnings, and right now it's around $17, $18 a share. Their earnings based on 5 analysts are for them to lose 5 cents per share going out to December 2017. I don't like to buy companies out the road a year and a half, 2 years that could lose money. So I'd have to be patient with this company and say, hey, let's wait to see if this company can make money selling or actually renting out and fixing up these single-family homes. So I'd have to sell it now. Can't buy companies that you're losing money with.
Warning, warning, warning.
Yeah, no profits means no purchase. That's a sell on American Homes for Rent, AMH. Tony in Las Vegas wants to know about Pinnacle Entertainment, PNK.
This is another one I was kind of excited about, like, I like what they do and so forth. You know, a great entertainment company. But then here again, I look at, what their earnings, year over year, their earnings are up 48%. So I got kind of excited. I looked at the analysts. Again, 5 analysts here. The stock's around $10, $11 a share. Their 52-week high is $11.75. 5 analysts, the average estimate's $1.54. Using our 16.5 average forward PE, gives you a target sell price at $25.41. So I got pretty excited until I discovered that they got $3.5 billion of debt on the balance sheet. Their debt to equity is about 8 times the equity. Not a good position to be in. And on top of that, they got about $1.5 billion of intangible assets. If things slow down the economy or they have problems, this could be a company to file bankruptcy. I don't like the weak balance sheet. I can't afford to buy this company. I got a place to sell on it.
What about my dreams? What about my money?
Well, to protect your dreams and your money, go for something with a stronger balance sheet. That's a sell on Pinnacle Entertainment. And last, for Joe in Colorado Springs, it's MRK Corporation, AEE.
MRK Corporation is one that we held years ago, made money off it, but the whole utility sector is way too high in price. You've got a company here trading around $50, $51 a share. Going out to December 2017, our target sell price is $45, so you're above that already. It is utility. I think people get excited because you're going to get 3.3% dividend, but utilities, including Emeren, they're all overpriced. Like a lot of companies, the S&P 500, I had to stay away and say, gotta sell it.
It's topped out. I say we sell now.
So take your profits again on Emeren Corp, AEE. And while that's a couple of sells, that actually kind of lives out what we were talking about, Brent, where it's tough to find the right values, but it's why we also appreciate having you on the show. Thanks so much for coming back. I hope you're not away so long the next time.
I'll be around next time. I'll be ready.
Thanks so much. Brent Wilsey is the president of Wilsey Asset Management. It's wilseyassetmanagement.com. Follow him on Twitter. He's at Brent Wilsey, and doing one, the other, or both will help you find out about his seminars, his radio stuff, all the other media things he does. If you want to get more information or get more from him. Well, we're just about done with today's show and this week, but we'll wrap things up, get you set up for next week and more before we finish the day right after this message.